What's going on, guys? Nick Foy here, under30wealth.com. Today we're covering financing for real estate investors. So scroll back up here real quick. This is the Under 30 Wealth website, the famous menu bar where I have my 6 most powerful resources here for you to click on. And then we've got the school. You can start if you want to learn more about how to become a real estate investor. I do not have a full-time job right now. I'm living off of income that I earn from real estate investments, as well as from a golf website that I created. If you watch any of my other online business videos on this YouTube channel where I talk about starting a website, building traffic to it, selling things on it, that's all done through my golf website. And then I also have that money going into my savings account where I then buy more real estate properties with. So if you want to learn more about real estate, you can check that out. And if you're new here, make sure you're subscribed to the channel before you leave. So financing real estate investments, this is the ultimate guide. Basically, it means how to find money to buy real estate investments. So first off, we're going to talk a little bit about debt and equity in real estate investing. All right, so defining equity. Equity is the value of an asset less the value of the liabilities tied to that asset. So in other words, equity is the cash that you would have on hand in that asset if you were to sell it. So let's say we buy a house and we get a loan, and it's a $200,000 house. We get a loan for $100,000. We put $100,000 cash into the property. We now own this $200,000 asset. However, equity would only be $100,000. Our debt would be the other $100,000 since we took a loan on it. So borrowing money from outside source with the promise of paying back the borrowed amount. Plus, typically you're going to have agreed upon interest that you're going to set to pay back on that debt as well. So not all debt is free debt. If it was, more people would be taking on debt because it's free. But normally there's interest rates involved. You have to pay back the debt plus interest, so it costs you money to borrow. However, it's a feasible strategy if you don't have the equity on hand or the cash value on hand to buy the property outright. So a lot of times investors will mix a little bit of cash and a little bit of debt in order to be able to buy a property. And in fact, most banks make you put down equity into the property initially. They don't want to take on 100% financing. They only typically want to loan 70, 80% of the value of the property. So you're going to have about 30%, 20% down payment you put down in cash of your own money. And that's where you're going to then start off with about 20, 30% equity in the property. And as you start paying down that debt, your debt to equity ratio is going to change. You're going to have less debt. You're going to have more equity in the property. So that's kind of the basics of debt and equity, what they are. Now, in terms of financing, let's go ahead and look at the different types. So with equity, again, you've got cash. So we kind of broke it down into 4 different topics. You've got all cash. We've got your cash. If you borrow family or friends cash, perhaps maybe they do give you an interest-free loan. Now you've got some cash you can use to buy the property with, to put the down payment on the property. If you get private investor cash, so maybe you don't actually, borrow money and take on debt. Maybe you're actually taking equity out of the property and giving it to another investor or a friend or a family member. So they're putting their cash into the property in exchange for some ownership interest. So that's what equity is. It's basically ownership interest, how much you control and how much you own of the property. So that would be the different ways. You either put your money in, you put some friends or family on a deal with you so they put down most of the cash, or you find an outside private investor that you pitch the deal to and they put up the cash to buy the property. So that's the types of equity. Types of debt, we've got conventional bank loans, commercial bank loans, a portfolio loan, FHA loan, FHA 203K. We've got hard money, private money lenders, seller financing, creative financing. So we'll go more in depth into each of those below. So I do have a whole other video on this if you want to search. It actually talks about how to analyze deals based on equity and debt. So if you buy a property with equity instead of debt, it shows how your return would look. A lot of times if you use debt, your return is going to be higher, but it's also taking on more risk. You're levered up taking on debt. So if for some reason property values go down, that equity could quickly disappear and you could be negative underwater on the property where it's worth less than how much debt you have out on the property. And that's where you saw a lot of people defaulting back in the mortgage crisis of 2008, 2009. All right, so starting with the all cash. So many investors, they choose to pay all cash for an investment property. It makes investing transactions easier. There's fewer or no complications. So when you see an offer on the table of all cash, if you're a seller, you're more tempted to take that as opposed to taking an offer that's trying to go get bank financing, because there's a lot of hurdles with going through banks. You might have to pass certain types of inspections, like if they're trying to get an FHA loan. So all cash is usually the king in a real estate transaction. Being able to just buy it like whatever condition it is. You might not have to worry about failed inspections by a lender holding up a deal. So you can just go in, buy it all cash, you can fix it up, and then later you can refinance and take a loan out on the property once it's in a favorable condition where the bank's willing to finance that condition on the property. All right, so in most cases with cash, briefly, let's keep covering it. So in most cases, the buyer is just going to wire the money from your bank account, or you're going to write a check to the seller. So when you're at the real estate table, there's an escrow account that gets opened with a title company, and they're going to give you a routing number that you can wire money into, or they're going to ask you to bring, a money order or a check to the closing table, and that's going to then get deposited into the escrow account to pay off the seller, to pay off all the other expenses, closing costs, lender fees, those sorts of things. All right, so we given a little example. If you had $200,000 all cash to invest, you could use that money to go and buy just all cash $200,000 property, or you could split it up and buy multiple properties. So we show you kind of why people choose to break their money up and take on debt to get a higher return on investment. So in this example, if Bob buys the $200,000 property, let's say it's in a pretty nice neighborhood, he might be able to rent that property out for $2,000 a month. So that's going to generate him $24,000 a year in rent when you figure $2,000 a month times 12 months. So $24,000 per year. It's going to be about a 12% gross return. So this isn't even factoring in any expenses yet. This is just, the gross income, and then you're going to have taxes, insurance, utilities, any other expenses throughout the year. So right away, your return's about 12%, and it's going to be a little bit less after that when you factor in all your expenses. So that might cut in half, and you might get about a 6 return. So you're going to bring in maybe about $12,000 a year in net income on that $200,000 investment. All right, so keep that in mind. But let's just use gross numbers to keep things simple. So 12%, $24,000 gross on $200,000 buying one house. Now, let's say we split that $200,000 up and we started making 20% down payments on 5 similar homes that are each listed at $200,000. So now we're going to put down about $40,000 cash on each property, and we're taking out a $160,000 mortgage on each property. All right, so the cash flow is going to be roughly $600 a month per house. And that's going to be about $3,000 per month in total when you add it up to about the 5 total houses, which is going to be about $36,000 a year. All right, so how did we come up with a $600 number? Well, a minute ago we were talking about how you're going to gross about $24,000 a year for just one property. Well, now if you're doing 5 times that, because you've got 5 properties where you split your $200,000 up and you're taking out loans on 5 other properties, you can multiply this number by 5. And you're going to be looking somewhere in the ballpark of about $120,000. Now, you're going to have expenses, which we talked about might be half of that. So that's going to cut you down to about $60,000. And then you're going to cut that almost in half because you're going to have a mortgage payment on all those 5 different loans. So that's where we're getting down to where you're going to have about $36,000 net income after you paid off all expenses and mortgages, which still, this $36,000 is about 3 times higher than the $12,000 you would have had. When you factor in all the expenses you're cutting out of the $24,000 gross, you're going to have about $12,000 left. So you're going to get $12,000 out of that one property, or you're going to have 5 properties with mortgages that you're paying off mortgages, and that's going to leave you with about $36,000. So you're going to have an extra $24,000 net income, plus you're going to have all that money that's going to pay down the mortgage. That's going to turn into equity as well as you're paying down your debt. All right, so that's a lot to take in, a lot of numbers. If you're, lost and confused, you can go back over it. It might make more sense, but it just shows you that, levering up when you use debt, it helps you get a little higher return on investment as opposed to, somebody paying all cash on a property. All right, so next we're doing the conventional bank loan. All right, so this is where we're going to actually start taking on debt. So like we talked about above, you're going to go to the bank, ask for a loan. So conventional loans usually have a 20% down payment requirement. All right, sometimes you can get away with only 5-10% down for these, but with tighter lending criteria, a lot of banks are asking for 20% down, especially if you don't quite have, the income or the credit score, to qualify maybe for that 10 or 15% down. So expect 20 down, maybe 25 to 30% for investment properties. Sometimes they look at investment properties as riskier. So they end up asking for a higher down payment. Not sure why it's riskier, because typically investment properties are getting rented out. So you actually have income coming in, as opposed to if somebody was buying that same house or that same property to live in, they're not going to have any income coming in from that property. So using it as a rental property should seem less risky, because you're actually going to have income coming in, as opposed to somebody who just lives in it as a homeowner. So I don't know quite why they think it's riskier and that sort of thing, but they might require the 25-30% instead of 20%. All right, so that's the conventional bank loan. Commercial loans, these typically have to do with like office space, industrial. If you're dealing with like apartment buildings where there's like 5 or more units, that starts becoming in the ballpark of commercial loans. These typically have higher interest rates as well, so that's something to keep in mind. To get approved for conventional and commercial loans, underwriters, they're going to look at market studies. They're going to look at appraisals, how much the property appraises for. So an appraiser is going to go out and assess the property and come back to the bank with an appraised value, and then that's going to tell the bank approximately how much loan they're going to offer. We've got borrowers' financials, so they're going to want 2 years of income typically. So if you could provide your tax returns, they're going to look at your credit score, and then they're going to look at the loan to value ratio. So they're going to take into fact, what the property's selling for, how much the appraised value is, and then they're going to look at the loan to value ratio there. So maybe the property's selling, $80,000, but the appraisal comes back and says it's potentially worth $100,000. So the bank might say we'll loan 70% of the loan to value. So if the value of the property on the appraisal is $100,000, they might loan $70,000 towards buying the property. And so if it's only listed for $80,000 by the seller, you can finance $70,000 of that $80,000. So you can almost get it 100% financed. You're still gonna have to put down $10,000 as a down payment, however. All right, then the debt coverage ratio. So on investment properties, the debt coverage ratio is just simply looking at what income the property brings in against the loan. So it's like debt to income ratio basically. So how much income is going to be able to cover the debt on the property, and if that number gets way too low, then there's not enough income, then the bank's going to probably say no to the loan on the property. They want to see a healthy debt to income ratio so that they know that there's going to be enough income coming in to cover the building expenses and still have money left over to go towards that loan payment. So you can learn more about that here, but we pretty much just covered it. They want a 1.25 debt coverage ratio. Typically, some banks might go down to a 1.2. So you'll see that on spreadsheets when people are analyzing properties. There will be a number somewhere that spits out that coverage ratio. Portfolio lenders. This is another option for financing. So let's say you've got multiple properties. You're trying to buy a portfolio of properties. Then a portfolio lender will, give maybe a big loan, kind of like a jumbo loan that finances the acquisition of all those different properties into one loan, so you're not taking out multiple mortgages. I think Freddie Mac, Fannie Mae, their programs, they used to only allow up to like 10 loans at once or something total for an investor. So I think it was like 4 loans, and then there's another program where you could get up to 10 loans. So if you're trying to buy, 20, 30 houses and scale your rental portfolio and own a bunch of properties, it's going to be complicated to have lots of loans out there. So you might be able to roll them all into like a portfolio loan where you just have one mortgage payment and it's backed by all those different assets. Sometimes this is less risky, so they're more willing to do this type of loan because you've got 10, 20 properties that are part of the portfolio. So if one of them's sitting vacant, it's not too big of a deal. You still have 9 other properties out there that are supplying rental income, so you're still able to meet the monthly mortgage payments. FHA loans are typically a housing assistance loan program from the federal government in the United States. It helps first-time home buyers especially because they only require usually 3.5% down payment minimum. so you can finance up to 70%, 97% of the property value. So that's one of the cool things FHA does, but there's lots of lending guidelines and restrictions, so it's one of the tougher loans to get qualified for. And you're also typically going to have to pay PMI, which is private mortgage insurance. So anytime you put less than 20% down on a property, you're going to have to take out PMI. So on top of your mortgage payment, you're going to have the PMI insurance payment as well. And it basically is like an insurance to protect the lender, so that if you start defaulting, then that insurance company, I think, is going to have to make it right with the lender since you're missing payments. All right, the FHA 203K loan. Again, this is another type of FHA loan, although the 203K loan, it allows a homeowner to purchase a house that's in need of repairs and rehab work. So it gives you the ability to finance some of those repairs or improvements into the loan itself. So it basically wraps some extra money into the loan so that you have some additional money that you can use. So you're going to get the loan for the property, and then they might roll back some money to you in the form of a credit so that when you come out of closing, you've got some cash on hand to go do the repairs with, and then that just kind of gets rolled into the loan. So you kind of have the cash on hand already, but they add it on to the loan amount so that you're going to have to pay that money back to them as part of the loan repayment program. Similar to refinancing, if you were to buy a property all cash and then you go refinance, when you refinance, the bank basically gives you money back, so they just hand over the cash to you, and now you've got a loan out on the property. So all that cash then goes into your bank account to do whatever you want with it. But it's ideal that you reinvest it. Otherwise, you're taking out a loan on the property and for no reason, and you're having to pay all that money back anyway. So you might as well invest it and try to make something off of it. All right, hard money, the next topic here. This is a typical one beginners turn to if they don't have money of their own. They go to a hard money lender. So hard money means it's got high interest rates. It's usually private funding. So there's different little small businesses out there that loan money out to people, and you can go to them for hard money loans. So again, they're going to have high interest rates, maybe 8 to 15%, whereas a bank's going to give you conventional financing. I think 30-year mortgage rates today are hovering around 4%. So if you go to a hard money lender, you're going to pay double, triple, quadruple that in the interest rate. Hard money typically is used for shorter term periods, so 36 months is usually the maximum. It's usually short term, so if you're flipping houses and you plan to buy a house, renovate it, and get it flipped in less than a year, then you could do well with a hard money loan. That way you can get the rehab funded from the hard money loan, go get the property all fixed up, sell it, and then you can pay back that loan without incurring a huge interest payment over that time period. If you're doing a longer term period loan, hard money, these high interest rates are going to eat away profits and eat away return on investment, so it's not usually smart to do. Sometimes you can buy down your interest rate by paying points, which are fees that you kind of pay up front. Many hard money lenders, they don't require income verification. They don't require credit references. A lot of times these loans won't show up on your personal credit report, and it can take just days to get approved for a hard money loan, so you can get it quite quickly, whereas conventional loans from a bank can take 30 to 45 days to get a loan process and approval done through the bank. All right, so hard money people, they pretty much know and understand that you're borrowing money for the investment property purpose to be able to acquire a property where you can't qualify for conventional financing, or maybe you're using some hard money as a bridge loan. So if you don't have the down payment to give the bank, you might go borrow it from a hard money lender, and now you've got cash on hand to put down on the property and still get a conventional bank loan on top of that. So that's one way to get creative financing and to finance a property 100% is you borrow 20% from the hard money lender, and then you take 80% out with the bank, and you use that 20% you borrowed from the hard money lender as your down payment with the bank. We've got private money, so this is just going to private individuals. So similar to hard money, you're going to go to maybe a family or a friend, or somebody that family or friends refer you to that has money, maybe a wealthy businessman in your city that you've made connections with and networked with. You can go to them, pitch them your idea of investing in a property, and they might be willing to lend you the money and at a set interest rate. So why would a private money lender be interested in loaning money to you if it's considered risky? Well, a lot of times they've got just money sitting in the bank. So rather than earning 0% interest rates in a bank account, they could stick it maybe in a CD, which is a certificate of deposit. that's only going to earn them maybe 1-2% interest rate. So instead they could loan the money out to you for real estate, and they could start earning 6, 7, 8% on their money if that's the agreed upon interest rate that you talk to them about. And so they're going to be earning way more interest from lending money to you than they're going to earn from the bank account or from a certificate of deposit investment. So it's kind of a way for them to kind of stick some excess cash out there into loans and earn money from lending. That way they can earn better interest rates. So that's kind of the pitch to make to hard money lenders and private money lenders is, hey, you're going to make more money than if that cash is just sitting, empty in a bank account. So that's something to think about when you're, talking to people that you want to pitch for private money loans. So again, here's some bullet points we cover in the article. It's a safe investment secured by real estate. So if you plan on renting out the property at a decent rent, you should have enough rent coming in to cover the loan repayment. So there's not a whole lot of risk there unless the property's sitting vacant and struggling to stay rented. If you're doing a flip, odds are you're going to make a decent profit on the flip. You're going to be able to pay back that loan if you're doing your numbers right. However, the reason it's also considered a safer investment is because if for some reason things go wrong and you can't pay back the loan, then they can just foreclose on the loan and they can take over the property from you. So their loan is secured by an asset called real estate, which has value. So that's one way they can get their money back, is in the value form of real estate. And then they can turn around and sell the property and get, all that money back that they loaned to you. It's also got higher returns. It's a predictable income stream they can get reliant on. So every month they can expect, that monthly loan payment coming in, and that could be a new income stream they could add to their cash flow statement if they're trying to figure out how much money they need for retirement to live off of. So that's something they can look forward to. That interest they're earning, that's extra money they're earning. That's coming in. We have no management costs. So if they were going to buy the property themselves and try to own the property, then they're going to have management costs, and they're going to take on headaches of managing contractors, tenants. They're going to take on risk of the property sitting vacant. So it might be more appealing to be the lender side of a real estate transaction where they can just sit back and collect money passively from the investor making the loan payments to them. All right, promissory notes. It's basically just a note you're going to chalk up that basically outlines the provisions of the loan. So it's like an IOU letter saying, I owe you this money back someday. So you're going to want to write the name of the borrower, the address, the interest rate, late charge amounts if you miss a loan payment, how much the loan's for, the term. So it just kind of breaks down like a contract, what the deal is with the loan so that you guys have a contract to abide by. Next, we're going to talk about owner financing, known as seller financing. This is another great option for purchasing property. If the seller owns the property free and clear, meaning they don't have any debt on the property, then they're probably going to be willing to offer seller financing, which basically just means they're going to carry the loan instead of you going to the bank and getting a loan. So they're not going to get all their money up front at closing. Instead, they're going to let you take a loan with them, and they're going to slowly get paid off over time. So they're going to, again, be the one lending out the money, collecting interest on their money they're lending to you. So you basically get to take over the property maybe for a small down payment of 5-10%, depending on what you negotiate. And then same thing with the private lender. You're going to negotiate terms, how long the loan is, what the interest rate is, and that's going to calculate the monthly payment you're going to be paying back to the seller. So the seller's basically getting rid of their property. You're taking ownership of it and living in it or renting it out, doing what you want with it. But they're still going to be on the title, and they're only going to drop off the title once you finally pay them off. That way, if for some reason you stop making payments, they can foreclose on you and they can get their property back. So seller financing is one of the best routes to go. It's hard to find homeowners that are willing to do seller financing. A lot of them want to just take their property, sell it, get all that cash, and put that money in the bank account or roll it into the next property that they're buying. So they don't have time to sit around and wait for their money to come into them from a seller financing loan. So sometimes you'll see them do short-term seller financing loans where they'll do like a balloon. So they might loan the money to you for 3 years, and then after 3 years they expect you to get qualified with a bank. That should be enough time to get your income higher, to get your credit score fixed and get that higher so that you can qualify with a bank. And once you qualify with the bank loan that you take out will then use to pay off the seller financed loan, and they can get all their money out of their property and they can move on with their life. So that's something to think about with seller financing. If you don't have to negotiate a long period of time, you can try to negotiate maybe a 3 to 5 year loan. So we talked a little bit about why somebody would do owner financing. Again, if they've got tons of money already and they're in the retirement stages of life, they might not need all their money right now that they're getting from the sale. So then they're not going to have to pay as much capital gains taxes anymore. So you're saving the money on taxes by rolling out smaller installment payments to them rather than one big chunk that they're going to have to pay a big tax bill on. So that could be another angle you approach. If they don't need the money, they can get small installments of it over the period of time, and they can look forward to those consistent checks coming in every month that they could live off of in retirement. We've also got home equity loans and lines of credit. So this is just tapping into your equity in your house. So if you bought a house years ago, maybe for $80,000 cash, and over time it's appreciated to $100,000, you could go to the bank and draw some equity out of your property and use that money as a down payment maybe on the next property or to buy the next property all cash. So it's basically taking a loan out against your personal residence. So that's one route you could go. If the bank gives you a line of credit, that's another way to do it. They'll secure the line of credit usually with an asset, which in this case could be your house or your car. And then you might, that way if for some reason you don't pay back that line of credit, they'll, come take your house from you in order to get their money back. Partnerships, we've talked a little bit about, it's another equity play. So we've talked a lot about debt financing, who to borrow money from. But if you want to go in with an equity partner, you could go into a 50-50 partnership. So you could find somebody who's got cash. You could say, hey, will you buy the property with your money? I'll put up all the work. So that's one way you can negotiate the partnership. They'll, put up the $100,000 to buy the house, and then you'll put up the other $100,000 in what's known as like sweat equity. So instead of, you putting in money, you put in work. So all the time you spend, looking at deals, sending deals, getting them purchased under contract. Once you buy the deal, you go in and handle the rehab process. You get the tenants put in the property to rent the property. You handle all the management of the property. So you pretty much make it hands off for your partner. And that's going to, be your fee that you're charging for all that work you're doing. So it's one way to get into a deal without putting any of your own money in the deal. You come up with a creative way or a creative partnership where you contribute sweat equity and labor, and they put up money, and they're more passive. They don't put up work and management and labor. They just put up the capital. All right, lastly, there's Roth IRAs, life insurance, other sources that you can borrow against to buy real estate. You're going to have to look more into that and talk to your accountant and look up the legalities of that. The tax laws have changed in recent years with the new Trump administration. So I'm not sure that these methods still work, but there are different retirement accounts that you can actually tap into and take loans out on, and you can go use that money to then buy real estate with it. And then, money that you make from the real estate investments, you can then pay back to those retirement accounts later. Or maybe they let you just buy straight from those accounts. So whatever money you've got invested in these accounts can be used to buy real estate rather than buying stocks or bonds or other types of assets you'd normally invest that cash into. So that's going to wrap it up for this lengthy video. It ran a bit long, but I wanted to cover each of the different topics in this article, different sources of financing on the equity and debt side. So again, you can check out the article. Here's my pin. If you want to pin this on Pinterest, it'll help us out. But we talked about debt and equity today, what each of those are. And then we had the different bullets for the different types of equity and the different types of debt. And we went over each of them individually. So I hope you gained some value from today's video. And if so, hit that like button, hit that thumbs up, helps us out, tells YouTube it was a valuable video. It should show to other people. You can also subscribe to the YouTube channel. And again, you can check out our real estate investing course to learn more about real estate investing over here at asknickfoy.teachable.com. Anytime you're on an article on my website, we've got this start the course button here at the top in the header section. So you can just click on that and it'll take you over to the real estate investing school, where you can start to learn more about the different modules, the different chapters that we cover in the real estate investing course. Everything beginners need to know. We go over advanced topics as well, like exit strategies. We talk about property management, contracts, closing tasks, legal entities, financing, analyzing deals. So we pretty much cover everything you need to know to get started. And again, it's over here on the asknickfoy.teachable.com domain, which I'll link to below in the video description. So thanks again for watching, giving me your time and attention on this video. And I look forward to creating more real estate investing videos for you so you can learn how to grow your income and earn passive income investing in real estate.